All right. So in terms of valuation of properties, you should always be looking at the income that is being generated. The income that is being what year generated. Income that is being generated. So how much are we generating? Maybe 20 million per year. So this income, we could either, of course, look at it in terms of futuristic. So we take the future incomes, we discount them. So today we are not looking at that approach. Today we are looking at a simple approach where basically we look at what we call the net income. How do we value a property using the net income approach? So this is number one, and this number one has got two sections here. We have A, which is the net income. The net income, and I approach. Net income approach. And straight away for us to understand what we mean with net income by this net income, to get net income, we basically take, ladies and gentlemen, profit or EBIT, earnings before interest and tax, minus what year? Minus interest. So anytime they want you to get net income, it is EBIT minus interest. I'm so sure you have done this with my colleague, this concept here. And you must have learned that when we talk of net income approach, we assume that there are no corporation taxes. That tax of 30% is not there. So this basically is like the PAT. Now that the tax is zero. This is like profit after tax. Now that tax is what here? Now that tax is zero. The thing that you're supposed to understand, ladies and gentlemen, is that who eats this entire income? Who eats this entire net income? The net income belongs to ordinary shareholders. NI belongs to ordinary shareholders. Write for us there that NI belongs to ordinary shareholders. Net income belongs to ordinary shareholders, and they shall receive this net income indefinitely, perpetuity, like that. They shall get this net income indefinitely. They shall get this net income indefinitely. Let me ask you guys a great question here. So today is International Women's Day. Assuming in this case that a good ninja here gets in this case here a great blessing from somebody, just to wish them happy International Women's Day. Somebody tells this great ninja that every year, I'm going to give you 10 million Kenya shillings every year. It's an income that I'll be giving you every year, indefinitely. And then you are told that the cost of capital is 5%. And this great ninja of a lady wants to know the present value of that 10 million receivable indefinitely, and the cost of capital is 5%. How will I be able to get, in this case here, this present value? How will I be able to get this present value? You guys talk to me. The concept here is indefinitely. Is there somebody who knows the formula? Indefinitely. Is there somebody who knows the formula? Thank you so much. You guys are great students here. So you're telling me that the present value will be equal to the annuity amount, divided by who? Divided by R, divided by the required return, divided by the cost of capital. I'm so happy. Are you able, ladies and gentlemen, to put this thing in a highlighter, yellow highlighter for that matter? You write this formula and then you highlight it using a yellow highlighter. Remember, the other highlighters are not very good. It's only yellow highlighters that give us conspicuous stuff that we'll be able to see very well in the future. So have you been able to, this is, the bedrock of my today's topic. Silver red, no, don't use red things. But I read somewhere that if you have chicken and you would want them to lay very many great eggs, that you should give them goggles, red goggles, which will make them be seeing the environment to be red. So red, in this case, could also be good. Orange. Why orange even? No, 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 no. No, no, no. Now, ladies and gentlemen, I want to rub. I mean, this is something that is crazy. This one here will help you. This one here will help you, my students. This one here will help you, my students. So it means that this EBIT minus interest, which is the net income, which belongs to the ordinary shareholders, we can then use in this case here, this net income to value the interest over the interest, to value the interest of equity holders as follows. That value of equity will be equal to EBIT minus interest, all over what here? Cost of equity, all over cost of equity. That we use normally the net income. We normally use the net income to value the interest of equity holders. Because I mean, EBIT minus interest, this net income belongs to equity holders. It belongs to equity holders. And to get this value of equity, please write this in full. Value of equity, it will be equal to EBIT minus interest, all over what year? KE. Let's look at May 2019. Let's look at May 2019. Somebody's talking about green. Yes, green is a good color. Actually, it's November. It's November 2019. It's November 2019. Question number 4, boy. Question number 4, boy. It's November 2019. Question number 4, boy. November 2019. Question number 4, boy. November 20. I would want to move slowly on this. I mean, this is great stuff. November 2019. Question number 4, boy. Question number 4, boy. Once you get that question, are you able, guys, to put your thumbs up like this? Like this. Like this. Wilfrida says yes. All right. All right. It's only one student who has got, Doris George has gotten this. Doris George has gotten this. All right. So November 2019, question number 4, boy. How to value properties using net income approach. Net income approach. Remember, the assumptions of net income, I believe you have this. Net income approach, ladies and gentlemen, the first assumption is that we assume that there are no corporation taxes. No corporation taxes. That is number 1. Number 2, we assume that this business of ours will stay with us indefinitely. Indefinitely. Very important. As much as we talk about the other assumptions, like there are no transaction costs, those 2 stand out for derivation of my today's concept, which I'm telling you that we shall always use this net income to value the equity shareholders' interests. Equity shareholders' interests. So we are saying here, November 2019, question number 4B. We are told the property A and the property B are categorized under the real estate category. Property A is all equity financed, while property B is financed partly using debt and partly by equity finance. I love that. Both properties generated EBIT of 41,245,900 annually. This is expected to remain constant each year in perpetuity. That same figure in perpetuity into the future. We shall be receiving that figure, the same figure throughout. Unlike property A, which is wholly equity financed, property B is financed partly by equity and partly by 10% debt of 215 million. The cost of equity is 12% for both properties, and there are no corporation taxes. Each unit of debt is trading at what year? At par. The cost of equity is KE, is 12% for both properties, and there are no corporation taxes. So required, they want us to give them the current value of each property using the net income approach. I mean, I know the ball. I know that this ball called net income belongs to equity holders, and I shall start valuing the interest of these equity holders, and I know the formula. So I will start in this case here with property A. Remember that property A is all equity financed. Property A is all equity financed, is all equity financed. Property A is all equity financed. Yani haina deni, haina debt. Ni equity wanasimama naye. So in this case, then how do I value this? To value this is very easy because it is net income approach. In this case here, come and tell us that the value of equity will be equal to net income all over what year? Cost of equity. So we value the interest of equity holders. And this net income is the one that we are calling EBIT. EBIT minus what we owe, the return of the debt holders. So that in these earnings, we only are left with earnings for the equity holders. Divide this by the cost of equity. Cost of equity. So, ladies and gentlemen, are you able to see the EBIT? Is there somebody who can see the EBIT? Oh, yes, I can see it up there in paragraph number 2. Both properties generated EBIT of 41,245,900. So 41,245,900 minus the interest. Interest mbesha shigana. Interest ngapi? Interest ni ngapi? Pata potea. Interest hapa ni ngapi? Si interest hapa ni 10 million. Interest hapa si ni 10 million. Thank you so much. You guys are great ninjas. This is all equity financed. It doesn't have anybody's debt. So there is no way you'll be able to pay interest is zero. And then you have told me that KE is a cool 12%. KE is a cool 12%. Masline, I would really request that you have your name starting with capital M. Today is Women's Day. It's your day. Your name to start with capital M. Capital M. Actually, kasirika yote kama Yvonne. Capital letters yote. Today is your day. Today is your day. Today is your day. So Shedi is giving me 343. 343. 343. 343. 715. 715, 715, Shedi, haujapumuaje na hata hujapeleka bibi out. Uko class. Sasa Shedi, wewe ni mwanaume na gani? Haujapeleka bibi out, unasema hujapumua na uko class hapa. Hiyo ni mambo gani? Hiyo ni mambo gani? We shall overcome. We shall overcome. So that is value of equity. That's value of equity. Value of equity. Value of Anasema tuna focus. Thank you so much. All right. So after you get value of equity, then to get total farm value, 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 we normally take value of equity plus value of what year? Debt. Remember, if even for example, when you look at your houses there, when you look at your houses there are those things that you have bought using your own savings. Those are items that are, you can say they are fully equity financed. And of course, that household, if you are a prudent financial manager, it must be having some stuff like even the structure itself, the house itself, being financed by debt. So anytime you want to know the value of your entire household, you look at, for example, this household has been supported by equity, and then we have got what year? Debt. So anytime you want to get total farm value, or total property value, sorry, total property value as well. Property value or farm value. Total property value, you will take in this case here the value of equity. The value of equity already you have this figure. It is 343. It is 343. It is 700 what here somebody? It is 700. It is 700 here and 15. It is 833. And then the value of debt in this particular case is what here? Is 0. The value of debt in this case is what here? Is 0. So automatically, the value of this property is 343, 715, 833.33 like that. Have we understood, ladies and gentlemen? Have we understood, ladies and gentlemen? Have we understood that concept really? Please give me feedback. Please give me feedback. Yes. Yes, and then I can see Laureen. I repeat again, no problem. I'll be able to repeat again. No problem, no problem. We shall overcome. All right. All right. So the cost of debt, yes, the cost of debt, remember here we don't have a debt, right? Property A is debt-free. Property A is all equity what here? Is all equity financed. All right, so no debt, no interest. And then, of course, net income approach tells us that, first of all, we have to start by getting value of equity, because net income belongs to who? Net income belongs to equity shareholders, to equity owners. So in that case here, then, to get value of equity, I will take net income divided by cost of what here? Cost of equity. And remember, this net income is what we have said. You take the earnings before interest and tax, EBIT, minus interest here, which is 0. This EBIT, they have given us in the question. They have given us EBIT in the question. If you look at this November 2019, paragraph 2, they have told us both properties generated operating a profit, which is EBIT of 41,245, 900. 41,245, 900. So minus 0 divided by cost of what here? Equity, which gave us this. And then now we came and concluded that at the end of the day, apart from equity holders, we must be having, in this case here, some value that comes from debt holders. Debt holders. However, in this particular question, it's an all equity financed firm, no value of debt. So it will be, the total value will be this value of equity plus the 0, which gives us the total firm value like that. So let's value property boy. Property boy. Let's value property boy. Let's value property boy. Let's value property boy. Let's value property boy. Thank you very much, my Corono. Remember, operating profit. Operating profit, always. It's good you have asked. Is PBIT, which is the same as what here? EBIT. It's profit before interest and tax, which is the same as earnings before interest and tax. Actually, you should write this and highlight this. Yellow highlighter. Yellow highlighter. Nancy Jerop is saying it's unlevered farm, yes. It's unlevered farm, yes. All right. All right. And then now from there, we go to property B. Now property B is the easiest. Property B is the easiest. Property B, ladies and gentlemen, now this one here has got equity and what here? And the debt. It has got equity and debt. So what do you think? Can I give you like 3 minutes to try valuing this property, and then we see you as a valuer, what value you'll be able to come up with? Can I give you like 3 minutes? And how I wish that the very first student will be able to give us the correct answer is a lady. We need to reward our ladies here. We need to reward our ladies. How I wish. How I wish. Today is a very special day for them. Very special day for them. Very special day for them. Nataka in this case niwapeleke out wote leo. Leo nawapeleka out wote virtually through what we call virtual reality, VR. 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 So we have Marilyn. We have Nancy Jerop giving me an answer there. All right. All right. So it is those two ninjas who are battling out for my great gift. Great gift. Great gift. Dan Wangui has also given us something, but remember, if you're a man and you get it right, you'll have to excuse me today. Today only. Today only. Today only. Today only. Okay. Thank you so much. I've seen one great ninja there. There is a ninja there who is very good. That the very first thing the ninja has realized is that property B has a debt. Has a debt within it. So this ninja, first of all, came and wrote down the debt. Unlike property A, I'm reading paragraph number 2. We are told unlike property A, which is wholly equity financed, property B is financed partly by equity and partly by 10% debt. So it has a debt of 215,000, like that. 215 million. So if it has got debt, then it must give us interest. So the interest will be 10%. 10% of 215. This is a free mark. And as Yvonne told us there, a free mark, even one mark, by the way, can make you go to places that you've never seen before. So 10% of 215 Let's see who is able to get my 500 bob. And I'll dictate how that money will be used today. I'll dictate how that money will be used today. Because pia I realize kuna wanafunzi wengine hawajui mambo mengi. Iko mambo mzuri hapa. 500 can give you something very nice. So Dan is giving me 21,500, sorry. 21.5 million. Thank you so much. Great. But remember, this person wants net income. All right. Then I'll be able to write the formula. First of all, I'm valuing the equity value. So to get the equity value, I'm using net income approach. And net income, ladies and gentlemen, is EBIT minus interest. Please, even if you are given tax, and this guy says use net income approach, depending on the model, the examiner tells you. Remember, these models here have assumptions. Like this makes an assumption that there is no what year, there is no tax. All over cost of equity. So what is the value of EBIT? What is the value of EBIT? EBIT, ladies and gentlemen, EBIT, ladies and gentlemen, EBIT has been provided here. It's 41,245. 41,245, something 50. Something, no, 900. 900 minus the interest, which is 21.5 million. And then whatever answer I will get, I will come and capitalize this. Why are we capitalizing this? It's because of perpetuity, that this income will be obtained indefinitely. And if it's indefinite, then we should take amount over R. Amount over R. Net income over R. So in this case here, net income over R of 0.12, which these guys were able to give me how much? Let's see. The value of equity, 164. I think Leah is the one who is correct. So Leah is getting my present. Leah ako juu ashapata tayari. Yeye ameshapata, ashaelewa kitu kabisa. So value of equity, according to Madam Leah, value of equity is 164, comma 549, 549, comma we have 167 like that. That's value of equity holders. And once also Jane has gotten this, and once you have been able to get value of equity, please don't forget to give us what we call total value, total property value or total farm value, which will be value of equity plus value of debt. So value of equity is 164, 549, 167. Value of debt remains the same. So value of debt is 215 million. Value of debt is 215 million. Value of debt is 215 million, which gives me 379 something. So in this case here, is it Leah was the very first one to get it right? Because I saw Leah got some number that I never saw some people getting here. 379, 549, 379, 549, 379, 549, 379, 549, 167 point something if you wish to put those decimals there. So Nancy Jerop is saying, Mwalimu, no, usituone mwalimu. The person who got it first is her. Ebu tuambie na alipata rakaraka ikitu correct. Tuambie rakaraka tumalize chapter. Tuambie rakaraka, usijivotie tafadhali. Votia friend wako. All right, so I'm checking this recommendation very fast. Hilda is basically coming up very well. So Hilda, I think you have won. Are you able to give me your number very fast, Hilda, without any hesitations? Hilda, without any hesitations, because you've been voted for. And because I'm going to dictate, I think this lady should be given 5,000. Oh, we check Nancy. Oh. Geez, I'm confused. I'm confused. You're confusing me. You guys have access to the chats. You guys are confusing me. You're not very nice. You're not very nice. You're not very nice. You're confusing me. You're confusing me. You're confusing me. You are confusing me. Okay. So part B, second model of this income approach is what we call the net operating income approach. Net operating income approach. Net operating income approach, what we call NOI. A little bit confusing, but very nice. Net operating income, what we call NOI here. What we call NOI. What we call NOI. What we call NOI. No, I'll give you a better present. I'll give you a better present. Let's forget about that because that one does not really have like a clear winner. That doesn't have like a clear winner. Let's forget that. Let's forget that, or later on I can check the charts. I can check the charts later on and then we discuss about that. The most important thing is for us to really understand what this net operating income. Yeah, results are disputed, yes. Now, ladies and gentlemen, how do we get this net operating income? So net operating income as well, we shall omit the taxes. The corporation taxes will not be there. Here, we will not factor in any depreciation. It shall not be there. It shall not be there. And we shall not factor in this case here, interest at all. Interest will not be subtracted. Interest will not be subtracted. So long as you understand those three things, that amongst those expenses I can never subtract whenever I'm getting the NOI. I will never subtract corporation tax. I will never subtract, in this case here, interest. And I will never subtract what your depreciation. Have you written that in your mother tongue somewhere? As a note, those expenses you can never subtract while you are getting this NOI, net operating income. You say there are three. All the other expenses, subtract them. From the question, never given revenue, subtract them. But you shall never subtract what? I shall never subtract depreciation. I shall never subtract corporation tax. I shall never subtract what? Yeah, interest while getting the NOI, net operating income. The moment I know that, then I'm okay. Then I'm okay. Then I'm okay. I repeat, remember, the expenses will never subtract. Expenses that will never be deducted while getting NOI. They are depreciation, they are corporation tax, property taxes you'll subtract, but corporation, that 30% you cannot deduct. And you cannot deduct what? Yeah, interest. You cannot deduct interest. It's not net. You know, net income, you subtract virtually everything apart from tax. Apart from tax. Now, ladies and gentlemen, I would just want to give you like a pro forma. How do we get this net operating income? It's very easy. So we take, in this case here, rental income, assuming full occupancy, assuming full occupancy, blah, blah, blah. And then we'll come and add other incomes, add other incomes, blah, 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 blah. And then we'll be able to get what we call potential gross income. Potential gross income. Now, ladies and gentlemen, of course, when you have a property, like if, for example, you have a property in town, CBD, commercial property, like, for example, Garden City is yours today. Could you kindly give me various types of incomes you'll get out of such a property? Are you aware that you'll be able to get multiple? Apart from, in this case here, rental income, there are other incomes you can get. Are you aware of them? Are you aware of them? If that property was yours, which other income apart from rental will you be able to get? Hey, you rich people. Hey, you Willis, I don't know. Have you been able to write Willis? It is just a simple thing. It's a simple thing, Willis, that the expense that you can never subtract. Don't subtract depreciation. Don't subtract, in this case here, corporation tax. Don't subtract interest. when you're getting NOI. When you're getting NOI, don't subtract depreciation. Don't subtract, move aside. Don't subtract in this case here, interest. Don't subtract corporation tax. Those three. Somebody should be able to take a screenshot of that note and send it in the WhatsApp group. It'll be easier that way. It's a simple note. It's a simple note. So in this case here, students have been able to tell me, Mwalimu, you know what? If Garden City is mine, I can see like two types of great incomes. I'm going to get rent. And then number two, there will be advertising costs. Guys will come and put great billboards there. They pay me. So those are what here, other incomes like that. Other guys have spoken about what here, service charges. So when I collect service charge, I'm able to pay my securities, I'm able to pay my cleaners. If there will be an additional, if there will be some profit, then that profit will be taken in as a other what here, other incomes. Other incomes. So add other incomes. And then you'll be able to get what we call the potential gross income. After you get this, then come and less the vacancy and the collection clauses. Less vacancy, and the collection what here? Vacancy and the collection losses. Yani nyumba ijaja. Ama unapoenda collect, kuna ma-agents, etc., advertising billboards, I like that, Muzoni. All right, you subtract. And once you subtract that, ladies and gentlemen, then you'll be able to get what we call the effective gross income. Effective gross income. You'll be able to get what we call the effective gross income. Effective gross income like that. Effective gross income. Effective gross income. Once you get, in this case, effective gross income, then will come and less operating expenses. You less operating expenses. You less operating expenses. Less operating expenses like that. And then now you'll be able to get what we call the net operating income. The net operating income that will discount. That will discount using what we call the corporate net operating income, which of course will assume that will be received indefinitely. So shall be able to discount this. Ili testiwa wanafunzi walilamba chini, nani kitu rahisi, hata nikiona tuna macho. I'll be able to come up with this very, very well. So now I would want us to get now into competition. Thank you very much. Good question there. What are operating expenses? If you allow me, I'll be able to answer that using this question that we're going to do. Using these questions we're going to do. Please allow me to just put down this question, then we'll be able to see the various examples of what here operating expense, like when you pay utilities. When you pay utilities, that is what here is an operating expense. Is an operating expense. Insurance, etc. Painting, etc. Those are operational expenses. So then illustration now. Illustration, or adjust the board, Ninja, not seeing. Omondi, is it this net operating income down here? Is it down here? If it's down here, I'll be able to carry the board up. It's busy. Or maybe hapa chini, huyu lazima nibebe board up kidogo ndio aweze kuona. Hivyo. Ninja, are you okay now? Don't make your fellow ninja to hold this whiteboard up like that forever. Ukiona ukimaliza sasa andika chini. Ukimaliza niambie, hey ninja, we are okay now. Omondi, are you okay now? Iko sawa. Ninja now is okay. Great. Thank you. Sasa andika chini huko. Nikiandika chini huko nimeona kuna mateso. Sasa andika kwa chini. Itakuwa andika kwa juu namna hiyo. So then now I should be able to rub this. Now I should be able to rub this. All right. All right. So I want you in this case here for some token of appreciation for being a great mother. Token of appreciation for being a great mother. A great mother, a great mother. Let me give you the question and then you give me the net operating income. I know what I shall do for us to be able to compete very well. For us to be able to compete very well. No, this is okay. This is okay. So we have an example here. I want us to compete very well. So we have here property size. I want us to compute very well. Property size is 350,000 square feet. Square feet. All right. Gross rental income per square foot. Gross rental income per square foot equals 10 Kenya shillings. Equals 10 Kenya shillings. Equals 10 Kenya shillings. Equals 10 Kenya shillings. Gender equal. Gender equal. No, today is their day. Today, Ronald, you must understand. Today is their day. Is their day. And we're going to give them a very good present. You'll be surprised. Other income, shillings, 80,000. Other income, shillings, 80,000. Vacancy and the collection loss. Vacancy and the collection loss, 2%. Vacancy and the collection loss is 2% of gross rental income of GRI. 2% of gross rental income. Vacancy and the collection loss is 2% of gross rental income. Property taxes and insurance. So we have here property taxes and insurance. We have shillings 200,000. Shillings 200,000. Then we have utilities and maintenance. Utilities and maintenance. Utilities and maintenance. Utilities and maintenance, shillings 725,000. Shillings 725,000. Then we have interest expense. Interest expense is 440,000. Shillings 440,000. That is interest expense. And then we have income tax. Income tax is 30%. So you are required to determine NOI. So the very first lady who will be able to get this, will get a very, very good present. Very good present. And then, of course, in this case here, if there is a male ninja who would want a cup of coffee, because the present will be so nice for the lady, she can give out something, that ninja. The ninjas were saying that we should be gender sensitive. We should be looking at gender equality. Olorin has a figure there. I'll give you exactly 5 minutes. I will give you exactly 5 minutes. Finished, right? Finished. 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 Let's see. So then in this case here, I'll simply do something very, very easy. Okay. Okay. So then what do we have, ladies and gentlemen, here? Very fast, I can see rental income if fully occupied. So just come and write here. So rental income, total, call it total. So the total, of course, we can see it is 350,000 square feet. And you know that 1 foot here goes for 10 bob. So this must have given you guys 3.5 million. How kutoka bure? At least tuko na hiyo. Do we have other incomes? Yes. Add other incomes. Add other incomes. Other incomes, we have 80,000. So this 80,000 then must have given you 35,80,000. So in this case, this is your gross potential. Remember, it's just potential. You may not be able to earn everything out of this. So this is your gross potential income. Gross potential income. So do we have any leakages? Do we have any leakages? Do we have any leakages? Yes. Less vacancy, collection losses. Less vacancy, and collection losses, So in this case, they are telling us that this is 2% of the gross rental income. So it will be 2% of what? It will be 2% of what? Pata potea. Very good. Hapo tu ndio mahali kuna tofauti. It is 2% of 3.5. This is the gross rental income. Remember, gross rental income. So the gross rental income was given here 10. This one here. So in this case here, 2% of 3.5. I'm surprised the ninjas were able to get up to here. So I'm going to lose that money for sure. I'm going to lose that money. Which gave you how much, ladies and gentlemen, here? Which gave you how much? 70,000. 70,000. So remember, please, that this 2% is not for this total here. It's not for the gross potential income. Because this is about, houses which are unoccupied. So it has to be rental income. So then in that case, ladies and gentlemen, you are able to come and give us the effective gross income. The effective gross income. So we have here our effective. Now it's no longer potential. Effective gross income. Which gave you guys what figure? Which gave you guys 35, 10,000. Which gave you guys 35, 10,000. 35, 10,000, something like that. 35, 10,000, something like that. 35, 10,000. Thank you so much. I hope I'll not be able to go further than that. So after that, ladies and gentlemen, we have here the operating expenses. So operating expenses, please label them. So what are our operating expenses? So our operating expenses here, less our operating, I'll just carry this board up again. Our operating expenses maninja hapa tuko na gani? Oh yeah. Operating expenses, the first one here is property taxes and insurance. Property taxes and insurance. Remember, this tax is what we call the land rates. Land rates. It's not the same as corporation tax. Don't tell me, Mwalimu, ignore that one. No. Property taxes are operational. If you are not operating, if you never had that building there, you'll not be paying. It's an operational expenditure. It's like lease charges. So in this case here, property taxes and insurance. What do we have here? Property taxes and insurance. Property taxes and insurance. I think mine is not very good. 200,000. Do we have any other operating expenditure? Oh, yes. We have utilities and maintenance. We have utilities and Maintenance. Mbesha Shigana, before I start lifting up this board. Utilities and maintenance, we have 725,000. Thanks, Hilda. I think, Hilda, you will be the first one to get this. Hilda, you're getting my present today. Utilities and the maintenance. And then we have here interest expense. Do you bring interest expense here? Do you bring income? Do you bring depreciation here? No. So we are through. We are through. We are through with this. We are through with this. So then what is our NOI? What's our famous NOI? What's our famous NOI here? What's our famous NOI? What's our famous NOI? 25,85,000. 25,85,000. So for the sake of these ninjas who don't see down, kabisa hapa, Ronalds and the rest, let me just lift a little bit like that. Paka waniambie mwalimu, now we are okay. Waniambie mwalimu, now we are okay. Ronaldo, great. Thank you so much. Dan, thank you so much. Thank you so much. Thank you so much. All right. All right. So in all fairness, bila kupenda mtu yoyote hata tujuani hapa, bila kupigia mtu debe tu, just for the sake of it, who was that first lady? First lady to have this thing correctly. Hilda, Ruth, Hilda, Ala, Ruth, I think Ruth has won. So Ruth has won. Let's give Ruth a present here. We need to be very good. Where is my phone really? Let's give Ruth. So Ruth, wameanza kuleta story ya Hilda tena. Oh yeah. Sitaki kuwa unfair, imagine. No, I don't want people to share. I don't want people to share. No sharing. No sharing at all. I don't want people to share at all. Kuna mtu ametuma nini? Kuna mtu ametuma hapa. Kuna mtu ametuma screenshot. Kuna mtu ametuma screenshot already. So Ronald, gender equal, Lorraine, Ruth A, victorious. So where is Hilda? So Ruth ndiye ako juu kabisa eh? Kuna mtu ametuma screenshot. Ruth ndiye ako juu kabisa. Wewe. Leo nyinyi si wapoa leo. Leo nyinyi si wapoa. Leo nyinyi si wapoa. Leo nyinyi si wapoa. Leo nyinyi si wapoa. Leo kusema ukweli, nyinyi si wapoa. August 2023. August 2023. Question number 3, boy. August 2023. Question number 3, boy. August 2023. Question number 3, boy. Question number 3, boy. Chris, you know it's a big present. I would want that present to go to one person, and then I dictate the present. I would want to dictate the present they will buy. I would want to dictate the present. Don't worry. I know when to give the present. Because hapa kuna mushkiri. Katikati hapa kuna problem. I'll know when to give the present. VAR check. So we want a virtual referee. So August 2023, question number 3, boy. Hata mzuri amejua VAR eh? So August 2023, question number 3, boy. Don't worry. Perhaps the present which I would want them to buy is something they don't like. Perhaps in this case here, the person who will be able to get that present from me atasikia mzuri zaidi. Perhaps the present that I would want them to buy, I mean, does not belong to them. They may not like it. That's why we're not getting a clear winner. So don't worry. We know when to give this present. Don't worry. We know when to give this present. We know when to get this present. We know when to give this present. So have we gotten this question here, August 2023, question 3B? August 2023, question number 3B. Now, ladies and gentlemen, I'm a tough examiner. And that is why very soon I should start, in this case, even setting like mocks for you. I'm a tough examiner. If I'm given this time round, in this case here, to set your exam, and then I feel like I should have a question coming from this area, real estate, this is how I will set it. This is my approach. So I would want to give you guys exactly 7 minutes. Muone vile Swahili hangaisha wanafunzi semester. Hata sio Swahili ngumu. Lakini kuna wanafunzi ambao hawana thick skin. Niko wanafunzi akisikia tu kwa kitu hivi anastuka sana. Alright? So I would want to see whether you guys, if you got this question, they want us, number one, for 4 marks to give them the net operating income, NOI, for the office complex. And then number 2, the appraised price of the office complex using the income approach, that income that you'll get there, using that income that we'll get there. 8 marks in total. 8 marks. Kuna mtu amekataa kitu. Uma amekataa. Don't worry. Uma amekataa. Don't worry. I know how to give the gift. Don't worry. So you see, like now, the moment you guys are still talking about Hilda, you're talking about Ruth, Angake, the guys are almost finishing this question. This is you should be able to get also a present. It's a big present. All right. So all students are doing this question in 7 minutes. In 7 minutes. Right. So 7 minutes are over. Let's see who has it. Let's see who has it right. It's either 801 or 17 something. 802, 800. 786. Noe is 8 something. Answers are quite different. Answers are quite different. Very different. Very different. We shall overcome. We shall overcome. We shall overcome. We shall. But at least you guys are great. You have tried. You know you have tried. That is the most important thing. You have tried. You have tried. You have tried. So according to some students, they're saying here that this NOE should be 786,000. Is there somebody who got 786,000? 786,000? Yes. Okay. Let's see. So we have the gross potential rental income. So gross potential rental income, rental income, rental income. They're giving me something they're called 1050,000. 1050,000. I would want the effective rental income. Here, of course, when you see them giving you potential, we have here gross potential rental income is 1050,000. We have insurance and taxes, utilities. So you don't have other incomes, right? So then straight away here will come under less what are the vacancy and the collection losses. So less vacancy and the collection losses, which is 2%. You guys took 2% of what? You guys took 2% of what? Sorry, you guys took 2% of what? Somebody should be able to take a photo there. Janet has a request there. Somebody to take a photo of today's notes. Today's notes. So in this case here, 2% of the 1050. Is it 6% or 2%? Allah. Vacancy and collection losses are estimated at 6%. You're right. Are estimated at 6%. 6%. You're right. So 6% of 1050,000, which gave you guys what amount here? Which gave you guys what amount? Hilda is giving me a figure of 63,000. Is that okay? 63,000. They're getting a 63,000. 63,000. All right. So then they came and you don't even have to show. Actually, you don't even have to show like this effective. All right. But just for the sake of it, effective rental income. You guys got what figure? Effective income. You guys got what figure? 987? 987,000. 987,000. Then once you get this 987,000, ladies and gentlemen, move with speed. You move with speed and less these other costs. You don't even have to organize it very well. No, just less these other costs. So we have insurance. Insurance and what here? Insurance and taxes. So insurance and taxes, what do we have? 78,000. Do we have any other cost? Oh, yes, we have, ladies and gentlemen, we have in this case here utilities. So what do we have here for utilities? We have 54,000. After utilities, we have repair and maintenance. Repair and maintenance of how much? Repair and maintenance of how much? 69,000. 69,000. Is there any ninja that brought here depreciation? After us having written that note there in capital letters, after us having written that note there in the Luo, in Luya language, in Kiborana language, a calm dancer, we wrote somewhere, we said under NOE, we should never subtract depreciation. We should never subtract, in this case here, interest. We should never subtract what here? Three things actually we said. Interest, depreciation, and the corporation tax. And the corporation tax, that's what we said, 3 things. Corporation tax, yes. So in this case here, don't bring depreciation here. Don't bring depreciation there. So I think we have been able to factor in all the costs. So are you able to, in this case here, subtract and give us our NOI? Give us our NOI. Give us our NOI. So if you give us our NOI, they're getting 700 what here? 86,000. 786,000. Umeona sasa kwa exam, ikija kwa exam hii semester, unaweza ukapata mark yote. Hii. Ikija hii semester, utapata mark yote. Uweka kidole hivi. All right. All right. All right. All right. All right. All right. Unajua mara mingi wengi mmenikujia after exam, ati mwalimu hiyo paper ni ngumu sana. Mimi nikiangalia nacheka tu. Hakuna kitu ngumu. FM utashangaa hakuna kitu ngumu. Nothing. Hata kila jina sijui nakaa namna gani sijui Markowitz. You should never be scared. You look at what is there. Do we have figures? Do we have probabilities? Multiply them if they are there. Multiply them. All right. If you're able to see like expenses and you're seeing revenue up there, subtract to give us profit. All right. So kitu najua AFM inataka ni mwanafunzi ukuwe jasiri. AFM kama isiwe jasiri, AFM itakuonyesha maneno. There are students who fail like 4 times. Hata hapa wanafunzi wakiwa honest atakwambia mwalimu, I'm doing this AFM for the 6th time. Hapa mwanafunzi akikwambia ukweli. Mimi najua shida si wajinga au si wanafunzi wajinga. Shida kubwa ni wanafunzi kutojua concept za AFM. So they go to an exam kwanza wakiwa na uoga mingi sana. Nakwambia mimi najionanga mambo mengi. Wanafunzi wanakopa AFM sana. The days I used to be an invigilator and I've always told you this story. Unaona naekelea mwanafunzi karatasi ya AFM hivi. Na ni mzee kuniliko hata. Ukimwekelea namna hii, mwanzo anaanza na makalamu. Zinaanguka zote chini pangala. Unamuokotea. Mimi napenda hiyo kitu ya kusaidia watu sana. Unamuokotea. Kidogo tena hata kabla ugeuke calculator chini pap. Kidogo ukimwangalia ameanza kutoa jasho. Atapita FM kweli? Haizi akapita FM. FM itaki uoga. FM itaki kuwa na concept and then of course go and tackle those questions very courageously. Very courageously. You will overcome. You'll overcome. Wacha hapo haki. We shall overcome. Shedi. We shall overcome. Uliguza roho. We shall overcome. Kwanza hapo kwa kuangusha. I think kuna shida. Na mara mingi FM by the way wanafunzi kitu wanataka ni wamuongeleshe tu. Mkiongeleshwa tu vizuri, FM is a paper that we should be able to pass very well. Pass very well. Very well. Very well. Na pia haitaki, what it doesn't want, ladies and gentlemen, is those students will postpone their studying. If you postpone your studying and then once kusoma zile wiki mbili za mwisho, utapata shida mingi sana. You need to get these concepts step by step. Tunaenda hivyo. Paka upite kabisa. Paka upite kabisa. Now from there, we look at part B. So part B, what do they want us to do? So part B, they want us to give them the appraised value of the office complex using the income approach. Of course, this one here should have been the net operating income, using the net operating income. So in that case here, to get value of the property, here we don't get value of equity first. Value of the property, I will take what we call the NOI divided by the cap rate. Cap rate is the same as capitalization rate. It's the same as cost of capital, cap rate. Cap rate. Willis is asking a very good question there. Willis is asking a very good question there, and I'll be able to address that. Willis is asking there, what about note 2? Recently, 2 buildings have been sold in the same locality. The first building had a net operating income of 1.5 million and was sold for 12 million. All right. The second building had a net operating income. So basically, they're giving you that information so you can calculate, in this case here, the return on investment. This return on investment is what will be used as what here as your cap rate, average of it. So in this case here, the return on investment. So I'm looking at now note number 2. I want to get note number 2. Note number two. Note number two. You know, in this question, they have not given you the cost of capital. In most cases, they'll give you cost of capital directly. But you see, at the end of the day, he has given me two properties there. They've given me the return of the property vis-a-vis the investment. So from that information, then, I should be able, ladies and gentlemen, to get everything I mean. So in this case here, come and give me the return on investment here. Return on investment, property one, property one. So in this case here, the return for property one, abracadabra, we got how much for property one? We got 1.5 million. Out of what here? Somebody out of the value, the sales value, the market value. The market value of property one is how much, ladies and gentlemen? And it was sold off for 12 million. For 12 million. Whatever you get here, please multiply by 100. You'll be able to give us the return on investment. I hope Willis will be able to understand now, given what we are doing here, So the return on investment, Shady tells me it is 12.5%. So are we getting this really? Are we getting this? Are we getting this? Are we getting this? All right. All right. 12.5%. Now, ladies and gentlemen, how about ROI? Remember, ROI in full is return on investment. Return on investment. We're looking at similar properties to help us value our property. We're looking at similar properties around our area here. So ROI for property number two. ROI for property number two. So in this case, your property number two, does it have any return there? Oh, yes, it does. It has a return there. So the return there, ladies and gentlemen, is 600 what here? 675,000. And then we divide this by its market value was sold for. So the market value there is 4,800,000. 4,800,000 times 100. So what are we getting there, ladies and gentlemen? What are we getting there? 14.06%, isn't it? So 14.06%. So in this case, at least we have got two different properties and we happen to be having like their values here. So we can easily come and give them the average ROI, which we shall use for our capitalization. Average ROI will be our cap rate. So the average ROI will be 12.5% plus 14.06%. Whatever we get, because it's averaging, you divide by 2. You divide by 2. You divide by 2. So what are we getting there? Hilda is giving me a figure of 13.28. 13.28. 13.28. So here we are getting 13.28%. 13.28%. I'm so sure here as examiners, as we bring this kind of a note, we simply want to use this note to twist students, to make students in this case here fall off the bus, going to cast them, saying, hey, we have passed, and then you're left behind. You fall under the bus. Because like now, this kind of a concept here swept off most of the students off their feet and they fell down. They fell down. Because there are some students in this case here, upon reading these many notes of the accounts here, and that's what we are told as examiners. It is sure that you have additional notes. Because there are students, whenever they read these additional notes, they start just hearing their own things, smoke in the head. They start like seeing like these are tongue twisters. If can't I, a tie. Where can't I tie a tie as can't I. So the whole 3 hours, it's can't I, and untie, and untie, and a tie is what is ringing in their mind. And yet it's a very simple thing. So what I would want to encourage you, ladies and gentlemen, as we get closer to our exams, we should never be panicking, but we should be studying. Let's study, colleagues. Study slowly. I know you are busy, but please create time, like 30 minutes. Like now, if I were you, like after I do this question here, it's like you have exhausted this real estate. You simply rely on this plus now the theory, plus the handout I've given you. You neka kando kabisa. Utaisoma tena. All right. Now from there, ladies and gentlemen, so I have the cap rate here. Then I should be able to come and do what here? Get the value. Get the value. Get the value of the property. So let's get the value of the property here. Let's get the value of the property. So how do we get the value of this property? It's very easy. It's very easy. So to get the value of the property, this is very easy. Value of property will be equal to the NOI divided by the cap rate. So the NOI here, you guys gave me a figure of 768,000. divided by 13.28%. What are we able to get at the end of the day? What are we able to get at the end of the day? 59 something, isn't it? 59, 18, 674. 59, 18, 600. 59, 18, 59, 18, 600. 59, 18, 600. 59, 18, 675. Like that. So Willis, did I end up answering your question, Willis? Did I end up answering your question? Hope, Willis, you got an answer to your query. So then that is it. Now remember, after getting this value of the property, if they gave me value of debt, if they told me that debt is, for example, 2 million, then out of this, I would have subtracted debt to get equity. Remember, NOI, unlike net income, NOI, first of all, you get total value, and then you can split the total value to equity and debt. Under NOI approach, you start by getting the total value. And then this total value can be broken down into equity versus what here versus debt. Equity versus debt can be broken down into equity versus debt. But if it's net income, we start by getting the components. We get value of equity plus value of debt to get total farm value. So, ladies and gentlemen, if I was to stop here, not stopping, but if I was to stop here today, what will you say you've been able to take home from today's session? The thing that you be able to say, this one, for sure, if it comes in an exam, I'll be able to pin this thing down with all its horns down and get everything correct. We have overcome. Michael Ronald. I like that. Very strong statement. It's in the Bible. The noi pro forma. Very good. Ronaldo, Roy pro forma. The noi, I mean. The noi. And the noi, ngoja kidogo. And the noi, ngoja kidogo. When they use cost of capital, do you have a question like that? Modoni, of course, these questions are not very many. For real estate, they're not very many. I think I've actually done all the computational questions of real estate. But you see, the examiner will simply come and tell you additional note 3, cost of capital is 30% or 20%. They'll tell you directly. If you get an examiner who is wishing you success, an examiner would want you to do what here to pass. All right. All right. Cap rate is like the cost of what here? Capital. Cap rate is like the cost of capital. Although later on, as I advance this a little bit, you're able to see that cap rate is the cost of capital minus growth rate later on. Because this semester, if I'm the one, of course, I cannot be given nowadays. I'm an old dog. Old dogs are never given exams to set because when they set, the exam becomes above standard for every student. But if I was to set, I'll introduce issues to do with what year growth rate. Where now cap rate will be equal to cost of capital minus growth rate. So, ladies and gentlemen, I think if we were to stop there for this class, we have done justice. It could look small for you, but I know this is very good. Very good. In terms of the present that I was supposed to give, I cannot give any present to anybody today. I'm going to buy myself a present because I'm the biggest mother, giving a birth to so many accountants in the industry. Over the 20 years I've taught accounts. Any place I go, for example, if I go to do it to Nairobi Hostel, I must always get people in the accounts. They take me round. Mwalimu, you taught us this paper. Mwalimu, you're teaching us today. So now I'm the biggest mother. So I'm getting my big present today. Thank you so much. Be blessed. Have a good night. Okay. Miss Sylvia, ametaka soda, then he will not be fair. We shall overcome. That's fair. I think that's the fairest thing. I mean, motherhood is about giving birth. Like now you guys are still well within my stomach. And I'm so sure you will be able to pass this paper. Be able to pass this paper. So thank you very much. Please, discussion group. Naona kuna discussion group mzuri sana inaongozwa na this lady called Yvonne. Start attending that discussion. Start attending that discussion. Don't miss discussion groups. They are very, very important. Thank you very much. Good night. See you on Sunday. Sunday. Okay, I can see a few questions. I think I've skipped some, which is very bad. 5 a.m. tomorrow. Yeah, I chose to go with the Women's International Day because remember the Men's International Day is normally put on the same day with International Toilets Day. Yeah, we are very, very unlucky. So I just chose to come to this other side. I chose to come to this other side and I'm very comfortable on this other side. Thank you very much. See you on Sunday. Bye. Bye.